Hi, I'm Peter Rose, founder of Longwood Currency Trading, and how to scale up Forex lot size. That's the discussion that I want to have today, because it's something that even if you're a beginner, your hopes are not to continue to trade a mini account or a full lot or something, that you're wanting to get trading larger lot size. And hopefully through watching my videos, you understand that as you move from trading all in, all out into trading larger lot size positions, you don't want to go all in, all out for various risk management processes. And also you're reducing your risk by staging in, and then you're maximizing your gains when you tap out with your full lot size staged in. But there's a balance in that process that I want to go through with you, so that you can sort of look at your own situation and determine how you're going to do this. I would say this with a caveat. Number one, I'm a day trader. Number two, I don't use high leverage. I don't use leverage at all. I'm 10 to 1. That's all I am. So I got $10,000 to trade one full lot. There's a lot of people that you could trade 20 full lots at 200 to 1 on a $10,000 account or whatever. This channel is not for you if you're trading at high leverage. I'm sorry, but that's not good risk management. I don't care who you're getting your information from. I don't care what they can do or how many millions of dollars they make. You cannot trade on high leverage, particularly when you're with less than a couple of years of experience or 500 or 800 trades under your belt. And if you're doing it the way that everybody suggests that you do it, by trading up on the daily chart because it's safe, you're not making enough trades a year to learn anything. You're going to need somebody to send you a signal or tell you what to do or hold your hand, and it's all going to be based on luck as to whether you're going to be able to succeed or not, for many reasons. In working the process of scaling up your trading, it absolutely does not include increasing the number of pips that you're trying for. As soon as you increase the number of pips that you're trying for and you increase your lot size, that's a recipe for disaster. And if you don't understand why that's true, send me an email, because you really need to understand this. Second of all, as far as leverage, don't do the leverage. When you are trading and learning all in, all out, you have to look reasonable. And all in, all out and day trading means that you're not going to get more than probably 20 pips a day, unless maybe you're in an NFP and you catch the direction right or whatever. But in standard trading process, you're really not going to get 20 pips or 30 pips. You might get close to that on average, but that's why I say in my videos, I'm not going to enter the trade unless the day is presenting me with at least 20 to 30 pips of free real estate between where my entry is and where this supposed profit target is. The profit target is a suggestion, not a target. It's what the structural components of the past price action are offering you. That doesn't necessarily mean that those components are going to be valid all the way up, because there are other conditions, particularly in the currency market, because of the reason behind the order flow as to why looking for those longer targets. And again, if you're a day trader, a long target is 20 pips. You might be more successful at doing 2 8-pip hops or something like that. But each time you go into trade, you're pushing the envelope on the elasticity of the price action that you've been following. So if you go in on a trade and you pull 8 pips out of it and you get out, and then you say, well, I'm going to go back in because this thing is really going in my direction, you are pushing the boundaries of that 20 or 30 pip boundary line. But when you re-enter the trade in your head, you're thinking, oh, I got 20 to 30 pips. But you may not. You may be solely basing your decision on the fact that you got a ripper going and you got out too early. So now you're going to go back in and you take all of those entry risk things and throw them out. Because instead of going to a short pip stop, because you are entering the trade 3/4 of the way through where you originally thought that it was going to get to, you disregard your stop and you go, oh, this trade is going to need room to breathe because it's gone, 15 or 10 or 12 pips now, and so there's going to be a retracement, and I don't want to have a 10 pip stop there. I'll go out to a panic stop to 20 pips. Well, guess what? Most of the time, the 20 pips is going to get hit, and now you made 8 pips, and now you've lost 20. So you figure the math out on that. In looking at the realistic amount of pips that you're going to be able to gain a day, if you say, well, I can't make any money at 20 pips a day. I got to make 20 pips a day. I'm trading a one full lot. I'm going to make $200 a day. That will help my income. Well, yeah, it will, but making 20 pips a day is probably not on average feasible. Well, what are the days, where are you going to put your stop? Where you're going to set your stop out at 20? And so every time you lose 200, and you're looking to push the envelope to get 200. By pushing the envelope, your risk goes up, so you're going to lose more than you should. So your risk-reward ratio, your win-to-loss ratio gets turned upside down. Maybe you're negative or jump ball trader. You have to focus on what's reasonable for the number of pips. Forget about fucking dollars. What's reasonable for the number of pips that you can gain. Let's just say, for argument purposes, that you can consistently get 10 pips. Maybe the currency pair or the time of the year and your expertise allows you to get 10 pips on average over the course of months at a time. As you look at your average position gain and it equals 10 pips. Not the fact that you traded for 2 weeks and your average win is 30 pips. Okay, you're just lucking out there. You have to be reasonable about what this pip gain situation is. I'm moving around here a little bit because this is my new camera that I'm working with. It seems to be very sensitive. In fact, I'm going to move away from that window. It seems to be very sensitive to light coming in behind and setting up a cloud. There's probably a cloud on my shoulder. I can see that in the playback thing. You'll have to excuse me. I'm not a filmographer. Pips are something that you need to determine what's reasonable for you, for the currency pair that you're trading, the time of day that you're trading, and a mix between trending and range-bound motion and averaging out. Oh, you're not going to learn that in 4 months. You're not going to have that data. You're not going to have enough data in 4 months, particularly if you're trading on a daily chart. I mean, you're not going to have any data. It'll take you years to get any data that I could be of any assistance with you at all. And then I probably couldn't anyway because I'm not a fan of trading on daily charts. But that's just me. I make my mistakes well enough anyway, trading on the daily chart, and I've taken some horrendous losses, but I know why I do that. I know what my problem is. The problem that I have is 40 years in real estate with a solid risk management process that screws up my risk management process in currency trading. I mean, it's just like, it's part of my DNA. So I'm struggling with that. So, if you're looking for somebody that's driving around in a Lambo and making $1 million, give up on that. I've already made my millions of dollars. I retired a millionaire from my real estate. Now I'm trying to mitigate the real estate rules and bring them into the currency so that I'm not encumbered by my background. You're not encumbered by that background, but because I am, I can show you where some of these stumbling points would be and help you through that. And one of those things is You have to be very, very careful about what you're considering a reasonable number of pips per day to get. Because as someone who's starting out in their trading process in the correct manner, not, oh, I don't care if you've been trading for 2 years. If you don't know what you're doing, you've been following signals, or you've just been lucky and you're just wallowing around, that time doesn't count. As far as I'm concerned, it doesn't count. You have to start over again with a good process that's repeatable, and then you can tell whether your consistency is there because of a repeatable process or because the consistency over the last 5 weeks has simply been statistical anomaly. Once you understand what's statistically correct, as opposed to you just flopping around and getting lucky, you're going to be 100% better off in your trading. I guarantee that. And this number of pips that you gain on a daily basis is really important because it comes into play when you start staging in your positions. So that when we're looking at taking your current 1 or 2 or 3 lots and you're going to start wanting to increase your lot size, now I don't consider trading with 1 to 3 lots very many lots. I mean, at 10 to 1, if you're going to trade 3 lots, you need $30,000 of trading. And I think once you're trading seriously in order to positively affect your job income, you're not going to do that on a $3,000 account unless you're trading at high leverage, but then your risk of ruin goes up. I keep repeating that, but I keep getting these emails from you guys, and you don't seem to get that. You don't seem to grasp the risk of ruin. You're more interested in listening to what these guys are doing that are making, $4,000 a day, and you're thinking that you're going to somehow take a $3,000 account and do that. I mean, just look at the probabilities of that and what's realistic and who's kidding who. So when you're trading in the 1 to 3 lot, 5 lot area, you think, oh, I want to start scaling up. Well, you better not be scaling up in the number of pips that you're trying to gain, because that isn't going to happen. That's the road to ruin. If you start breaking a 5 lot position up into, well, I'm going to enter with 1 or I'm going to enter with 2 and I'm going to add 1 and whatever, or I'm going to enter with 3 and add 3 more or whatever. I don't think you're at that point getting paid for the risk that you're taking. When you look at the yearly outcome of staging and farting around and stuff at the 5 lot, or let's say where I really think that the building positions and staging and large lot size comes into play, is the 8 to 10 lot capability. $80,000 to $100,000 account at 10 to 1. You could trade 10 lots on a $3,000 account if you did it at 500 to 1. So, but again, you have to bring yourself down to reality. Oh, I'm sorry that I'm telling you you can't trade with 8 lot positions with less than $80,000 or maybe $70,000 or something like that. It all depends on what the price of the currency pair is. But, if you wanted to start a home building contracting business and you had a little tiny Jeep or something, you couldn't haul the lumber, you don't have any employees to help you, you need money to invest in your business. If you're going to start a car dealership, you need money. You need money to do stuff. If you want to drive your car, I'm sorry, gas is $3 a gallon or whatever it is, and I don't have enough money, but I want to drive my car. I don't know, take it to the edge of a hill and get in and push it down the hill. But unless you've got the money to spend to put in the car, you don't have any gas. If you don't have enough money in your bank, then you can't trade large numbers of lots. And if you are short stacked in your bank and you're trading large numbers of lots, again, your risk of ruin goes up. So Maybe you can't envision that today as a 1 to 3 lot trader, that you would be able to have 80 or 100 or $200,000 in your account, so that your positions were $200 a pip and you make 8 pips a day. You're making you're making $1,600 a day on the same number of pips. You just need more money in the account. Well, let me tell you what happened to me in 2023 as I began to sort through my stuff, sell off buildings, so I had money to have in my account. I started off in that 1 to 3 lot range trading. And again, I had plenty of experience. I knew what was going on. I didn't have the full picture at that point yet as to the situation that I was in with my 40 years of real estate experience, and what that risk management was ultimately going to do to my trading during 2023. I was up 80% on my bank going into the end of toward the fourth quarter of 2023. I was up 80% on my bank. And the way that I got there is I started out 2023, like I said, trading 1 to 3 lots. And then I went from 3 to 6, and I went to 6 to 8. And finally, within about a 7-month period, I was trading 20 and 25 lot position sizes. And then it all went horribly wrong, and I lost 6 figures. Big, 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 big. Lots of money. And that carried over into 2024, into this year. I didn't lose 6 figures, but I lost a lot of money again. The trades were tied together because I was holding trades too long and all that stuff. Because I had gone up in lot size too quickly and had combined that with wanting to get a few more pips, and so I decreased my risk, or I increased my risk by dropping the entry stop, so that I wasn't getting out of those trades. I was holding those trades and letting them build, and I was growing them, but I was growing them at the wrong time. You see guys out there that are able to reverse stage. In other words, the price goes against them and they start adding to the trade. They have a long stop so that the trades that they're adding as the price goes against them are costing them less than the trades that were at the beginning. And when they hit their 20 pip loss, their average loss is no more than what it would have been if they would have simply gone in with the full lot size position and taken a 10 pip loss. So they got that balanced out. That takes a lot more skill than I had at that particular time. Plus, I'm totally ingrained in this thing. You don't add to losing positions, but I was watching what these guys were doing. I was going to say, well, I got to do that because I'm sure that the price is going to turn around and go in my favor. And so I had the larger lot sizes to do that. I thought, well, I'll go in with 5 lots, and it's going to go against me, and I'll stage in another 5 on the way down. Well, it doesn't fucking make any difference. By the time I'm done, I've got an average, I've got a position size of 10 lots, taking a 20 pip stop. Even though the latter lots that I'm putting in weren't that effective against the stop, you're still talking about 10 lots going south on you, or 15 lots going south on you at 20 pip loss. So I'm losing $2,000 or $3,000 or $4,000. But my win to loss ratio was fairly high, I thought, because when I am when I'm an all-in trader, and I had enough, I make probably 400 trades a year. So I make about 600 transactions a year, 600 or 700 transactions. But of those, there's only about 450 or so positions that I have. So I'm trading a lot, a couple of times a day is what it would work out to be. So I have a lot of of data in the beginning in all in, all out, which is where you build your metrics. And I'm a little over a 73% win to loss trader in all in, all out. However, when I go to staging, and I didn't know this at the time, I thought I was a 73% win to loss trader. When I stage in, because I'm probing the market with those extra lots, my trading drops to basically 60-40, about a 63% win tag. But I didn't know that at the time, that would so drastically impede on my win to loss ratio. And so what was happening, because I didn't realize that, I was taking far more risk than I should have. Actually, I wasn't taking more risk. I was simply losing more than what I thought. And I began to say, oh, well, I don't have to worry about losing $3,000 or $4,000 at a time, because even on a 6 losing streak loss, because at 300 trades a year, I have a statistical likelihood I'm going to lose 6 times in a row. Well, I have a statistical likelihood I'm going to win 6 times in a row. So the fact that I lose $3,000 6 times in a row, $18,000, wasn't affecting me because I had such a large bank. And because I thought my win-to-loss ratio was 70-30, I'm not correctly evaluating those situations. And I'm trying for a few more pips. And I'm expanding my loss below that, because I thought that was all the process of staging. After losing 6 figures, and not just $100,000, I lost more than that. But I ran some simulations on that staging process and moving my stop from 20 pips up to 10, up to 8, and looking at the differential between opening the trade with this number of pips and staging in with this number and that number, altering the distances between the staging points and the value of the stage and where the stop was going to float to, and I got all that stuff worked out. And I didn't run that stuff off. Again, I lost all that money in 2023. I lost a lot in 2024. In the beginning, up to probably about June, I was a net loser. And then July, August, September, I just flopped around. Sometimes I have a winning month, sometimes I have a losing month, because I'm still trying to work this stuff out, trading with the larger lot sizes, staging, because I had become comfortable at the staging. I had done all this analysis and stuff. And so, okay, so I made 11% on my risk in November. I lost a little bit in October. I made a little bit in September. So I'm gradually starting to get the drift of things. But I only started to get the drift when I made the decision back in September. Let's not trade large lot sizes. Let's trade a smaller account and be all in, all out. And then once I get comfortable with that, then I'll start maybe staging at that 3 or 4 lot position and try to stay within my boundaries. And guess what? Everything improved dramatically. And I can tell you exactly why that happened, as far as how to scale up in Forex lot size, because I've got the math behind it, and I've got the trading results that constitute success with that, and as well as where I've made errors. And when I make the errors, I tend to lose a lot of money, because again, I'm comfortable with that from the dollar standpoint because of my previous experience. So I'm trying to pull the bad stuff out of the previous and add it in. The folks that are working with me right now they're all in, all out traders. They're just working their way through. They don't have these problems. They're not pushing me to do staging or compounding or stuff. That's going to come later. So that helps me too, because if I'm enforcing rules on them, that I have to have and use those same rules. So we're all going to benefit from that experience. But I want to tell you, with my experience in doing this stuff, I just have to warn you that if you do not understand the differential between trading small lot size positions all in, all out, and then trading larger lot size positions where you do begin to stage, where is that point that you have the trading metrics in order to say, oh, I'm ready to do the staging part, not only to trade large lot sizes, but I'm ready to start staging because I understand the risk management part of it. So how do I do that? If you don't understand the math that goes behind that, and it's not calculus, it's arithmetic, if you don't understand the math that goes behind that, you're going to make some serious mistakes, either with your stops or with the number of lots that you're staging at the different levels, or the distance between where those lot staging points are and where you set your trailing stop in the whole position, and how that's going to affect the early building process, as opposed to it's not going to have hardly any effect later on in the building process. And the fact that when you are trading the large lot size positions and you're staging, you're really not looking to make any more money on an average daily basis than you were making when you were trading 4 or 5 lots at a time. Because you have to be willing not to get your whole position involved until it's safe. And it's not safe until certain conditions happen where when the loss comes, it doesn't wipe out all the gains that you've made. This is complicated stuff. I always say that trading is simple and learning how to trade is simple. It is simple until you run into large lot sizes and you're going to start building and staging into positions. That's not simple. When you have the right rules and you understand the process, it's simple. But to learn that and to figure that out is very, very difficult. So before you start doing that, or you think about taking your 5 lots, and don't do that. Don't take a 1 lot position and break it into 10 minis and start staging and thinking, oh, whatever I'm doing down here with the 10 minis on the 1 lot full position, I'll be able to do when I've got 10 lots, and I'll just stage in 10 times with the single full lots. I'm sorry, but it doesn't work that way. It's not going to work that way. It's just not going to work that way for you. Step back from your trading as to wherever you are now as far as the current bank size that you have. And if you have a question about where I think you should be in your staging and all that process, send me an email and I'd be happy to try to give you some advice. But again, that advice is so narrow and specific, it doesn't take into consideration whatever base it is that you've built and whatever your trading plan is showing you what to do with that information. You can't just say to somebody, "Oh, this is how you turn the ignition on in your car." If they don't know anything about the car, they don't know how to even get in the car, let alone to turn the ignition on. And even if you show them how to turn the ignition on, what do you do with it then? Because they don't know whether to step on the brake pedal or the gas pedal or put it in reverse. They don't know. So I can solve turn the key on in the ignition problem for you. But if you haven't built a strong base, and if you don't understand where that base is trying to take you through the particular problem that you're experiencing, me solving that problem for you isn't going to do you any good. And as evidenced by the fact of all these people that have these courses in the training, and so many of the students are not successful because the educational process is not organized correctly. And I have a whole video on the correct educational process. I have a white paper that I've written on the educational process. It's 10 pages. So it's not a trivial thing to say, oh, I'm going to read a book and I'm going to learn this stuff and I'm going to call this guy on the phone and I'm going to ask him these 3 questions and I'm all set. That ain't going to work that way. Sorry. Don't mean to break your bubble, but I'm out of coffee. So Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.